Good morning, everyone. Thank you so much for joining us. We're ready to begin today's webinar. Chris, if you don't mind starting the recording, please. Thank you. Okay, well, thank you so much for joining us this morning. We are very excited to bring you one of the most requested webinars of this year. The name of the webinar is 2026 Snapshot, Current Market Conditions, Emerging Risks, and Practical Strategies. More than 80% of our members voted for this topic. To me, this is a clear signal that water and wastewater risk managers are navigating a rapidly changing landscape and are looking for timely, practical insights. As we move through 2026, we continue to see pressures from evolving insurance market condition, aging infrastructure, regulatory changes, and as you can see today, if you're in California, climate-driven events, cyber threats, and supply chain volatility. At the same time, there are meaningful opportunities, from stronger underwriting engagement to innovative risk financing strategies and enhanced resilience planning. Today's session is designed to provide three key takeaways. First, a clear view of current market conditions. Second, insight into emerging risks and how they may impact our organizations this year. And lastly, the practical strategies you can apply within your organization, whether preparing for renewal, strengthening controls, or briefing your executive leadership and the boards on the current market conditions and how to navigate them. And now I was going to turn it over to our moderator, Shari Deutsch, but unfortunately, due to some last-minute emergency, we have to pivot. But after all, we are risk professionals, and that's what we do best. So I will introduce our speakers and turn it over to them. First, we have John Chino. He is an Area Senior Vice President with A.J. Gallagher. John is a member of a leadership team at Gallagher Public Entity Division and oversees development of public agency risk management program. His expertise includes program design, marketing, consulting, implementation, and self-insurance administration, as well as account oversight. In January of 2026, John started his 44th year at Gallagher. He's also a member of the faculty of the Risk and Insurance Educational Alliance, where he teaches the Certified School Risk Management program and is a course instructor for the Institute. John is also currently Vice President of the USC Marshall Peter Arkley Institute for Risk Management. Thank you, John. Our next speaker is Seth Cole. Seth is the Senior Vice President in Alliance San Francisco office. Seth has spent 26 years at Alliant, providing insurance brokerage, risk management consultation, and pool administration services to public entities and water utilities across the country. Seth currently serves as an advisory board member for Certified Public Risk Officer in Water and Wastewater Program, CPRO W2. Seth, thank you so much for joining us. John, with this, I'm going to go ahead and turn this over to you.
Thank you, Vladimir. I have tremendous admiration for this group. I have not previously participated in any of your meetings, but I was doing some research work on PFAS, and I watched 4 or 5 times each the excellent presentations that were provided at I guess a couple of years ago. And so I'm well aware of the very high caliber of presentations that this group is used to, and I hope to meet your expectations. So the 80 some odd percent who voted for this particular topic at this time, you are 100% right. There are changes afoot that are compelling, that are interesting, and I would say present a lot more opportunity than threat. And that has not been the case so far in this decade. Now, why is that? So I have 5 or 6 technical slides that I'm going to be sharing with you because I want you to be able to understand not only that these changes are happening, but why are they happening? So you can explain to management and your peers. So this first slide I call the supply and demand slide, and it represents capital, reinsurance capital, that needs to be deployed. And so when the supply of reinsurance capital is high, it's a buyer's market and prices go down. So now let's talk about the insurance companies themselves. This is their lifeblood. This is referred to as policyholder surplus. And this is quite a long period of time. We're starting in 2006 and we're going through to 2025. So I draw your attention to the end of the slide. We're at the point where the bars are going up to a much greater degree. Policyholder surplus is the lifeblood of the insurance industry. This is what allows an insurance company to write insurance policies. And as you can see, their supply is up, which means they can write more insurance, and their management is going to expect that they will write a lot more insurance. All right, the property and casualty insurance industry combined ratio. This is how the industry scores themselves. It's a very simple formula. It is a comparison between the premium they take in and what they pay out in respective claims. And I've put a line there at the 100 because every time the bar is above 100, that means that they paid out more in losses than they took in premium, which obviously is not their goal. They're trying to either be at 100% or slightly below. And as you can see, since the beginning of this millennium, they're doing pretty well in hitting that goal of being below the 100%. But notice the bars there that are in gold. Those are actually predicting what's going to happen in 26, 27, 28, and 29. And note that the prediction is the combined ratios are going to go over 100%. What does that mean? It means that insurance underwriters are going to come very close to writing insurance at the amount where the losses exceed the premium. They're going to come as close as they possibly can. Again, this is what? This is a signal for buyers. All right, now the combined ratio does not include investment income. So let's look at the bars if you add investment income into it, and this actually is to determine how much they're making. And once again, I draw your attention to the very end of the chart where you see the most recent years. Now, 22, 23 were not good years, especially in respect of personal lines. Their income wasn't up, but they came back very strong in 24 and 25. And so as the insurance companies make more money, they attract more investors who say, I want to get in on that profit. And again, management is looking at underwriters saying, hey, we're doing great. We need to write more insurance. Again, good for buyers. All right. Yeah, you need to tap it again. So this is how their investors are doing. It's called return on equity. And they'd like it to be above 10%. And as you can see in the most recent years, the return on equity number, it's there at the end of the chart, is going up. That means investors are doing very well. They're making money on the amount that they've provided to insurance companies, and they're going to be providing a lot more. So in respect of all of the signals that we would use to look at the health of the insurance industry, to try and determine what kind of market are we going to see in 2026, every single benchmark is good. So I didn't think I was 6 weeks ago, 7 weeks ago, when Vladimir reached out to me and said, "Hey, can you do a market report?" I didn't know I'd be showing this slide. But in the last 6, 7 weeks, it has become clear to me that we are in a buyer's market. Now, in respect of liability, does that mean rates are coming down? No, no, we're not there yet. But it does mean that rates are going to stabilize. It does mean that the increase to the rates will be lower than they've been in past years. And I think for water, this is particularly good news because you're on the right side of being an attractive client. Now, underwriters are going to be careful. We're going to talk about some of the negatives, right, in respect of losses. We still have unprecedented loss trends, right? Losses are going the wrong way. They're a lot higher from year to year. So this isn't all good news. So underwriters have to offset that. They're going to pick the right type of clients that they want to do business with going forward because they have new business budgets. You saw their numbers. There's more people investing. There's more capital. They need to write more insurance, but they're going to pick the winners and try and avoid the losers. And the things that are going to be important are your personal loss experience, which for water tends to be better. The type of risk, your sector is a sought after sector. Now, geography matters a lot, and California is still challenged. Washington is challenged. Oregon is challenged. Arizona is kind of neutral in the middle. New Mexico, Colorado, not popular, right? Those are tougher geographical areas, tougher jurisdictions. Okay, this is the tough part about liability, right? There we have not one, but we have many different factors that are combining together to increase the cost of liability claims at very high levels year after year. And because there's so many, this isn't a simple fix. And we have clients that are talking about lobbying, and there are other issues, but this is there are many things to be sorted out in order to change the trend on claims costs. So I'm not saying claims costs are going down. What I'm saying is that the overall insurance market is at a place where they want to sell more insurance. And so you're going to hear from Seth. Seth's going to talk about what's happening in respect to property. The last place they have left to write more insurance is going to be in liability. All right, this is again another slide, and I look at the circle there in the middle, not the, I'm sorry, not in the middle, but the top one, where we see an increase in tort costs over time at almost 9%. This is when we think about CPI, right? Everybody's running around with their hair on fire because CPI is at 2.5%. This is at nearly 9%. It's way out of line. The increases are way beyond inflationary increases. And this is why we refer to it as social inflation and nuclear verdicts, because from a financial perspective, it's much, much higher than inflation. You see the amount there, the tax, the so-called tax on every person in the United States. There's real costs associated with it. Okay, so what do you do? How do you position yourself to take advantage of this opportunity? This opportunity has not happened in this decade, right? You have to go back to the last decade since we saw a market that was stable, a liability market that was stable. We've been in a rising, hard liability market since 2020. So credibility is king, right? You have to position yourself, which as a water entity should not be difficult, as an attractive risk with a positive risk profile. You need to be prepared that we are still in a place where one carrier, two carriers, three carriers, four carriers isn't going to write your risk. You may need 8, 9, or 10 carriers to do it. That requires collaboration and cooperation. And finally, you need to be creative and you need to be flexible. We have an expanded number of ways to provide excess insurance. We're now using treaty reinsurance. We're using captive insurance companies. We're doing this because the claim cost side is not going down. We have an opportunity to take advantage of a market that is willing to meet us halfway and provide better pricing, but we still have significant claim costs to deal with. All right, I'm going to change the topic. I'm going to talk about workers' compensation at this point. So I described the liability market as being stable and providing opportunities. The workers' compensation market has been stable for many years, for decades, and it's something that we could rely upon. Well, that's changing, and not in a positive way. It's changing in a negative way. And you can see here, California has 127% combined loss ratio for workers' compensation. So earlier I showed you a slide where, and I'll show you the combined ratio slides for the entire industry, but at 127%, that means that they're paying out $1.27 for every dollar that they're taking in. And this has mostly to do with medical inflation and increased severity of claims, along with an expanding legal landscape and the blurring of lines with hybrid remote work, which expands liability. So what do you do about this market? Now, when I think about workers' compensation and I think about the impact on the water sector, you've been self-insured for many years. So what's happening to insurance companies in respect of their claims costs, in respect of their losses, is also happening in your self-insured program, right? So we have the issue of we're going to be spending more money on our self-insured claims, and then we have the issue of how does this impact excess workers' compensation, the excess workers' compensation that we buy. So we need to face the facts. Our landscape is changing. It is not as stable as it has been in the past. Now, when I say review your claims for accuracy, right, you're checking the reserves for your third-party administrators, also verifying payroll. In some cases, because we have a lot of union employees, we have an increase to payroll amounts, but frankly, it doesn't increase the exposure because we're just catching up on increases based upon what unions can negotiate. We need to be clear about that as we give these figures to our excess workers' compensation carriers. Good news. There are opportunities in the workers' compensation market. There's a couple of new companies that are out beating the bushes. Again, this is because there are a limited number of places for insurance companies to meet their new budgets. And one of the places they're going to try to do that is on the excess workers' compensation side. All right. Vladimir had asked that I speak to trends. I've chosen 5 trends that I think are significant: changes to FEMA, PFAS and litigation, hydroclimatic whipsaw, AI is everywhere, and then workers' compensation trends. So changes to FEMA. Now, on January 28th of last year, when the new administration came in, they established something called a FEMA Review Council. And the idea behind the FEMA Review Council was to determine, are there ways to, as it was characterized by the administration, to streamline FEMA, to make FEMA better. Their perspective was FEMA was wasting money. And so this FEMA Review Council was together for about a year. They were supposed to come out with a report. It was widely expected that the report would say something along the lines of the federal government should do less in respect of FEMA and state governments should do more. That report never came out in December. It's not going to come out. And my latest understanding of the FEMA Review Council is the FEMA Review Council may not even exist in 2026. However, there's still a lot of pressure on FEMA We'll see. This is something you should be watching closely. That's my opinion. Okay, litigation and PFAS insurance. What I wanted to share with you on the litigation and PFAS side is uh, that PFAS has been modeled by the modeling agencies that try and predict what is the next big issue relative to liability, and PFAS has come out very high on that. There is an expectation that AI will make environmental claims much more widespread, easier to do, because the AI can track US EPA reports that have been sitting in plain sight that nobody's been doing anything about, and it can cross-reference them with health claims coming out of, say, a specific zip code. So there you go. You have a great formula for more environmental claims, thanks to AI being able to match up the health concerns and the EPA reports. Hydroclimate whiplash. This is something that we're going through right now here in California. However, California is not the only place. This is a worldwide issue for geographic locations that are in that latitude, similar to the California latitude. And basically, the issue is this: a warming climate allows the atmosphere to hold a lot more water. So it's not necessarily that we're having more days of rain. What's happening is when it does rain, we get more rain now than we used to get in the past. And part of this whipsaw is you have a couple of years of drought, and then you have a lot of rain. And I believe this presents two issues for water. The first is that we have inverse condemnation claims related to mudslides and falling earth. And that may or may not be our fault. I mean, it could just be the land is saturated. And then the other issue, of course, is we're in the water business. And so we have the couple of years of drought, and then we have a lot of water. Are we able to capture that water and preserve that water? Okay, AI. Personally, I mean, I believe that artificial intelligence is going to make the water sector better. I believe it's going to bring significant efficiencies to the work that you're already doing. And so I don't want this. I think the positive side is more significant than the negative side. However, there are issues, there are risk issues that come from AI, and a significant risk issue that you have to keep track of is the regulatory issues around AI. And whether the use of AI results in additional discrimination claims or patent infringement claims. So overall, I think it's positive, but there are risks that we're going to have to talk about and be conscious of for the next several years, and hopefully provide insurance for it. One other thing I would say about AI is going to make ransom claims even more common than they are now, because even a very unqualified hacker can use AI to perform a ransom event. Okay, finally, in respect of workers' compensation, I alluded to this earlier during my report that we're losing some of the stability on the workers' comp side. I believe for water, one of the biggest issues is you tend to have employees for a long time. People love working for you. Well, that's kind of a negative right now, because you have an aging workforce and their claims are a lot more expensive than a young workforce. A challenge for excess workers' compensation carriers are complex claims, because they can reopen claims that were closed, but also they're very expensive. Even the pharmaceuticals associated with complex claims are expensive, along with the potential treatment. And there are enhanced litigation opportunities because of remote litigation. So we have these very aggressive LA-based attorneys who are now able to work basically in every jurisdiction throughout the state of California. So at this point, I'd like to turn over the presentation to my colleague, Seth Cole, and I'll tell you, you're in for a real treat. Seth is one of the true water experts in the country, and it's a pleasure. I'm looking forward to hearing his presentation. Take it away, Seth.
Well, thank you, John. That was a great presentation. As I get set up here, let's see if I can do this right from the beginning. What do you all see?
I see your title slide.
Yep.
Perfect, fantastic. I can't see any of you, but that's okay. Again, that was a great presentation, John.
Thank you.
You know, you'll actually, for the group, it's very interesting. There is some crossover between liability, property, and cyber. So very interesting. And as we go through this. So big picture, what impacts the property and casualty insurance market? So all of these things, whoops, I got to get to the next slide. There we go. All of these things that you see here, John touched on some of these. I'm going to focus my presentation on property and cyber. You'll see that I have cyber attacks highlighted here. We're going to get to that a little bit later in the presentation. If you look down the right hand side of the slide, these are all the pressures on the property market: aging infrastructure, climate change, inflation, supply chain, and labor shortage. And we'll get into some of that a little bit further as we get into the presentation. So when you think about, you know, what impacts your property premiums outside of your losses, what has the biggest or single biggest impact on premiums? Natural disasters. Floods, severe convective storm, and wildfires are creating an increasingly long-term impact and led to total losses of $166 billion in 2025, of which around $98 billion was insured. The destruction caused by these perils was greater than the inflation-adjusted average for the past 10 and 30 years. But despite these losses, the insurance industry is turning an underwriting profit. John had talked a little bit about the combined ratio and got into the mechanics behind that a little bit, but that's good news for all of you. There's a lot of words on this slide, but let's focus on the trend lines here. The 10-year average for natural catastrophe insured losses from 2013 to 2022 was 90 or 89 billion, almost 90 billion. You know, the 5-year average from 2020 to 2024 increased to 115 billion. This is concerning for carriers. The trend line is moving in the wrong direction. Since 2020, Swiss Re said that claims have risen by about 30%, driven sharply by rising costs of building materials and higher wages. Also, supply chain disruptions and more population settlement in areas susceptible to disasters have also put underlying upward pressure on claims. Hold that thought. We're going to get back to that thought in a minute. And the key takeaway from this is that claims costs have far surpassed inflation and growth, particularly since 2020. John had kind of talked to that on the liability side. The same is happening on the property side. Taking a look at billion-dollar weather and claim disasters back to 1980, there's a heavy concentration of losses in the Gulf states and California. You might be thinking to yourself, well, that makes sense. California has earthquakes and wildfires, and the Gulf states have hurricanes. However, that is correct. However, remember when I said, hold that thought, more population settlement in areas susceptible to disasters? Have you heard about the bullseye effect? Look at population growth back to 1950. You see a heavy concentration in California and the Gulf states. There is a correlation to catastrophic insured losses and the bullseye effect. According to Swiss Re's head of catastrophic peril, 2/3 of the recent rise in weather-related disaster losses is a result of more people and things in harm's way. After disaster strike, we continue to build in disaster-prone areas. All right, to touch on some emerging risks as respects to the property insurance market. Um, Aging infrastructure and deferred maintenance. I recently read the cost to address aging infrastructure in the US is nearly $3 trillion. When things break down, that correlates to more property losses. Severe convective storm and flood. John talked a little bit about this as well. What is severe convective storm? You know, this is something that largely impacts or affects the Midwest. These are thunderstorms, wind, and resulting flooding that kind of come out of nowhere. It's not, you know, a little bit unexpected. Whereas we see more severe flooding across the country. And in California, I mean, right? It's not supposed to flood in California, but we've had a track record of atmospheric rivers in recent years. And I don't know about all of you, but I can actually hear the rain hitting the window right now. So we're, big storms in California and across the country as we speak. Wildfire, going to get in a little more into that in the next slide, but this is not just a California problem. Used to be largely thought as a California problem, but they can happen anywhere. And we're seeing them in parts of the country where we never would have expected to see them. Florida, Minnesota, New Jersey, Canada, which is not the US, but it's a big problem in Canada and throughout the Western United States. The FEMA gap. How many of you heard about the FEMA gap? Well, you just heard John talk a little bit about, what's happening with FEMA. A lot of people are referring to that as the FEMA gap or the FEMA outlook. The current administration is proposing major reductions to disaster aid. These changes will shift much of the financial responsibility onto state and local governments. And the question begs is, well, local and state governments have the funds to help when disasters strike. We just might not be able to count on FEMA in the event that we have these significant catastrophic losses in the future. But as John mentioned, there isn't certainty around what that might look like. We're all kind of waiting to see how that plays out. There is a potential solution called parametric insurance. That's an entire webinar its own, so we're not going to get into much detail on that now. But I would recommend that you contact your broker and ask about that, because it's something that you ought to be familiar with, and it might be a potential solution to cover catastrophic losses in the future. Want to just circle back to flood real quick. This particular concern for water and wastewater operators. Treatment plants, you typically are in low-lying areas to take advantage of gravity, and they're most susceptible to flood risk. All right. Here are some facts and figures on the 2025 wildfire season in California. As you can see, a lot of structures and acres were burned. There were 31 fatalities. These were mostly related to the LA fires. And you see these insured loss estimates from 2025 wildfire season, upwards of $40+ billion. This is almost all entirely related to the LA wildfires. Wildfire is front of mind for property underwriters in California and across the country. There are a lot of lessons learned from the LA wildfires, but what really stuck in my mind is that urban areas can burn just as easily as rural areas, and that's a wake-up call for everyone. Particularly in California, over the past 5-6 years, we've seen some pretty significant losses, insured losses by water districts. One I can think of is that, some water districts, at least in California, still have wooden flumes. We've seen some pretty significant loss when wildfire burns those flumes, as well as a large water agency that actually owned the water meters, homeowners' water meters at their homes. And when an entire neighborhood is ravaged by wildfire, those were insured losses to the water district because they owned those meters to the tunes of tens of millions of dollars. All right, what you've all been waiting for. How much is my property insurance going to cost this year? The property market is soft, losses matter, but overall, most of you should be expecting rate reductions this year. So what can you do to strengthen your renewal position? Data integrity is king. It's critical that you have complete schedule of values, that you have COPE information, construction, occupancy, protection, and exposure. Underwriters are really honing in and focusing, and the expectation is that you have complete underwriting information. Insurance to value has become a real hot button. This is another lesson learned from the LA fires, is that demand surge can significantly increase the value of a claim. Appraisal should be a key part of your narrative, that you are taking steps to ensure your assets are properly valued. Also, you want to highlight your wildfire mitigation efforts. As I mentioned earlier, this is top of mind for most property underwriters. Geography does matter, but no matter where you are, underwriters are thinking about wildfire. Also want to touch on underwriter submission activity. It remains very high. There are several new markets that are open for business. And growth is an emphasis for nearly all property carriers. So they're being flooded with submissions. So it's imperative that you engage early and access the global market, essentially be in the market to get the best deal. All right, we're going to shift gears to cyber. Best way I can show you the state of the cyber market is this chart, and it reads stability. Rates have been stable, and most entities have seen rate reductions over the past year or so, and this is despite the increase in ransomware activities. Speaking of ransomware, and business email compromise are the leading cause of loss. For cyber carriers. However, the percentage of attack victims paying a ransom has declined over the past 5 years as businesses are relying more on restoration, backups, and remediation strategies. So in short, ransomware incidents are at an all-time high, but ransom payments are down considerably, and as a result, the market continues to be stable, at least for the time being. All right, so talk a little bit about emerging risks related to cyber. Americans rely on the supply of safe drinking water and wastewater treatment every hour of every day for personal use, as well as supporting other critical infrastructure sectors and the nation's economy. Ransom is one of the biggest risks for water and sewer, and water and sewer is considered critical infrastructure. So what can you do? CISA and the EPA have developed resources to protect against and reduce the impacts from threats posed by malicious cyber actors looking to attack water and wastewater systems. I would highly recommend you check out their website if you haven't already done so. Can't have a conversation without talking about artificial intelligence. It crosses all insurance lines of coverage and has an impact. I agree with John that the good hopefully will outweigh the bad, but there's a lot of good things that we can take away from artificial intelligence. However, some of the bad is cybersecurity related. You have AI-powered phishing, deepfakes, automated malware, data poisoning, and AI model theft. Essentially, this is making the unsophisticated cyber bad actor or cyber criminal more sophisticated and puts you all at risk. Another trend that continues is these phishing attacks and social engineering. What is social engineering? The best way I can describe that is by way of example. We see this, we've seen a lot of claims as respects to capital improvement projects where you have multiple contractors working on a particular project. Someone in accounting gets an email from someone purported to be one of your contractors saying that, hey, we just changed all of our banking information. Could you please send the next payment to our new bank? And here's all of the information, right? And then monies get sent and it happens to be a fictitious contractor and you've just been scammed. We're seeing a lot of losses in this area. All right, as I mentioned earlier, the cyber market is stable, but we're starting to see pressure on rates, particularly entities with losses and or poor cyber hygiene. What can you do? Start with implementing MFA or multi-factor authentication. This is one of the first questions that underwriters ask. Underwriters are also focusing on operational resiliency. Do you have an incident response or business continuity plan? And have these plans been tested in the past 12 months? These are the types of questions that underwriters are asking. Also asking about AI. Are you using AI for your business purposes? And do your vendors use AI? And if your vendors are using AI, how are they using your data? And then lastly, another focus area is employee training around phishing and social engineering schemes. And that's all I have for you. I went through it pretty quick, but I wanted to make sure that we had ample time for Q&A as we wrap up. Thank you very much.
Thank you, Seth. Very insightful presentation. And John, thank you very much for yours as well. We're going to turn it over to Chris to moderate Q&A. Chris, please go ahead and read the questions that we've received.
Yeah. The first question from our audience, what or how big will AI have an impact on insurance and liability? And should we be looking out for anything regarding AI as risk managers?
Seth, do you want to go first on that, or how do you want to?
Yeah, I'm happy to go first and give you kind of my take. I think the insurance industry is trying hard to catch up to AI from a coverage perspective. It's not really being addressed at this current point in time. And I kind of think back to like, cyber, a couple of decades ago, where the insurance industry really didn't address cyber. We continued to see general liability policies and other types of policies pay cyber claims. And the industry decided that it was going to begin excluding that loss and created a whole new industry, cyber liability. And we all now buy cyber liability insurance policies and likely see that AI moving in that direction. One of the big players in the cyber liability space, Beasley, has indicated that they're working on a new coverage part for their cyber policies, an AI coverage part that will specifically identify what they intend to cover and what they don't intend to cover. John, any additional thoughts?
Yeah, so Seth, you're absolutely right. From the risk financing perspective, we should be looking at the industry to help us to expand the coverage that we have through our cyber forms. But on our own, do you have a regulatory policy? Do you have a policy rather that deals with regulatory issues? In California, we're leading the way in terms of AI regulatory requirements, right? So we have to do, just as with cyber, as Seth pointed out, do you have MFA? Do you have EDR? It's up to you first to protect your agency from the risk. And then if it works out that you don't protect them from the risk, then you have the risk financing to follow. I don't think we have any idea as to how big this might be, but we know where we need to start, and it's with the regulations.
Thank you both. Chris, do you have any other questions?
Yes. Thank you, John. Our next question is, how important is it to have a relationship with the insurance industry beyond my broker? And John, if you want to start.
Right. So the water sector has a lot of positives. You are different from other entities that are common in the public sector. Typically, you do not have law enforcement, which is one of the biggest hazards by far, and also do not have minors, do not have a significant exposure to minors. I know you might have some, schools come and visit and that kind of thing. So you need to be able to share your story. What are the risk management techniques that are going on in your entity? I work with a couple of water districts. They actually have broker tours where they bring all their incumbent carriers and some carriers that are not on their program yet, but we'd like to have on the program. They come out and they tour the facility, and without a single exception, they always come away saying, wow, I did not realize the high level of professionalism associated with the water industry. So if you do not have relationships with your current insurance underwriters and insurance underwriters that may be on the program in the future, because I'm telling you, there are opportunities right now. You need to protect yourself on the workers' comp side, and there are opportunities on the liability side. That is going to provide long-term stability for your organization, having those relationships. Do not rely upon your broker to take care of it all. Seth?
Yeah, I completely agree with everything you said, John. The only thing that I would add is that, no one can tell your story better than you can, right? And so it's critical that you get in front of underwriters and tell them your story.
Thank you. Our next question, and we'll start with you this time, Seth. It was mentioned that the insurance industry turned an underwriting profit. Can you explain what that is and its impact?
Yeah, absolutely. And, John actually did a really good job of walking you through a number of charts that illustrated this. And the one in particular was combined ratio. And essentially, for every dollar the insurance industry collects in premiums, what are they paying out in claims and overhead, right? And as John mentioned, anything under 100% is an underwriting profit, anything over 100% is an underwriting loss. And as you saw from that chart, 2024 turned an underwriting profit, meaning that the combined ratio was less than 100%, and the projected combined ratio for 2025 this last year is predicted to be not as much of an underwriting profit, but still to be an underwriting profit, which means that that opens up capacity and frees underwriters to provide more underwriting capacity, which is good for all of us because that ultimately brings down insurance premiums, or at least keeps them stable.
Chris, I'm gonna jump in for a second. There was a question earlier that got deleted from the chat, but I just wanted to mention it and bring it up. Seth, do you know if cyber liability carriers offer tools to their insureds for regular training of their employees and managers on cyber threat detection or simulated attacks or something like that?
Yeah, I would say that most cyber insurance carriers have a suite of resources and tools that are available to their policyholders that include training, threat assessments, white papers, sample, incident response plans, and the like. So it just really depends on who your cyber liability carrier is and how robust their service offering is. But also look to your insurance brokers. Insurance brokers have a lot of these similar resources that can be made available to their clients.
Great, thank you. Chris, I think there is a question from Tom.
Yes. Yeah, so any best practices that underwriters are looking for or regarding property value schedules? For example, how often should those values be updated in terms of yearly or biannually? And any guesses if they will demand property evaluations current as of a certain number of years?
Yeah, it's a really good question, John. If you don't mind, I'll take the first crack at it, and then you can improve upon my answer. Yeah, absolutely. When we look at property appraisals, it's a snapshot at a point in time, right? So it tells you what the expected replacement cost is at any given time, right? And inflation and other factors, demand surge, can impact the cost to replace damaged property at the time of loss. General rule of thumb, people look at every 3 to 5 years to have property appraisals done, where you have a third-party professional that comes and appraises your values and gives you a professional opinion on what they think the replacement cost value is. But you can't just stop there, right? You need to factor in inflation and use different trend factors. And there's a lot of different resources out there, Marshall and Swift, ENR, and other organizations that factor in the cost of building labor costs and things of that nature. And it's geographic, right? You have a Western region, a mid region, a Northeast region, to keep up with your values. So you should be trending your values every year. John, anything to add?
Yeah, Seth, yeah. So prior to the recent hard market for property, we did have clients that hadn't had appraisals for years, but then underwriters said, fine, if you don't have an appraisal, I'm just going to add 20% to your price as a contingency because I know you're way undervalued. And so it was cost effective to do the appraisal at that point because you didn't have that 20% penalty. The market's soft now. Will underwriters continue to say, hey, I need an appraisal? I think they will. Seth pointed out why, because we have all these climatic losses related to climate change. But even if they didn't, I think you need it. You need it because you need to know the value of your assets before there's a loss, because we're finding out the hard way, as Seth pointed out, with the very large fires in Southern California last January, that undervaluation it's not fun. It's not fun to end up with a lot less money to replace an asset based upon your prior appraisal or statement of values. So it's in your interest to have the appraisal done, aside from the fact that it improves your risk profile in the insurance marketplace.
Well, and on that, just a follow up. I mean, some of our member agencies have hundreds and thousands of properties, and it may not be viable to get all of them appraised in 1 year. Is there a practical approach that you would recommend for us to consider?
As Seth pointed out, you do it over a 3 or a 5 year time span. We recommend to our clients that they start with the largest values first and cover, maybe in the first year, even though you're only covering 20% in terms of the number of assets, in terms of valuation, it might be 60%, right, of your valuation. So there's nothing wrong with a 5-year period to complete. And Vladimir, we have school pool clients that have over 30,000 buildings, and they do a 5-year appraisal, and they don't seem to have any problem with it.
Okay. Seth, anything you want to add, or is that?
No, okay. John was spot on.
Chris, do we have any more questions, or are we good to?
We do. Cool. The next question is, why are cyber carriers in particular concerned about critical water and sewer infrastructure?
Yeah, so I'll take the first stab at this, and then let John chime in. Yeah, so if you want to cause disruption, right? Cut off the drinking water supply and affect people's ability to flush their toilets, right? So the cyber carriers believe that critical infrastructure, particularly in water and sewer, are targets, and that you're more apt to pay a ransom to avoid disruption in service. Another concern is that some of these water and sewer organizations are still operating off of legacy systems that were built before cybersecurity was really a concern, and haven't caught up with that yet. So these are all things that are concern to cyber carriers that lead to more scrutiny in the underwriting process, and fewer cyber carriers who are willing to offer coverage. John?
Yeah, I don't want to start any conspiracy theories or anything like that, but a lot of cyber events are carried out by nation states which are not friendly to the U.S., and they love nothing more than to create disruption in urban environments or suburban environments, and water's a great place to go for the reasons that Seth already pointed out.
And just to point out, about a year ago, we had a presentation by CISA to this group, to talk about how they can work with your agency and what kind of tools they can offer for free. So please go ahead and check with me or any one of our steering committee members, or you can just find the presentation on our website. And it had specific contact information for your local CISA representative. Don Hester is the one for San Francisco Bay Area, and he mentioned his colleague that covers Southern California. So please feel free to look up that information. It was a great presentation, has a lot of valuable information in it. I think we have one more question, Chris, from Tom, and then we're gonna conclude. Or more of a comment.
Yeah, I believe it was.
Okay. All right. Yeah, so Tom from San Diego Water mentioned that water and wastewater is #1 focus of DHS currently, especially in California, because we just had Super Bowl, there's World Cup coming up, Summer Olympics, so there's probably going to be significantly more focus on this subject by both, the people who are trying to hijack our systems, as well as security experts who are trying to help us to protect it. So please take a look at that presentation. And also, we are going to be doing a separate AI presentation and implications for public water and wastewater agencies, as well as how and where you should consider various types of coverage that would help if there was an incident involving AI. All right. Well, thank you so much for those very thoughtful and insightful questions. We're going to go ahead and conclude. And as we wrap up today's session, I want to thank all of you for joining us and for your engagement and for the focus that you bring to the community of water and wastewater risk professional. A special thank you to John Chino for his excellent presentation on excess liability and workers' comp. John, you gave us a very clear view on how those markets are evolving, where underwriters are focusing their attention and what we can do to strengthen our position ahead of renewal. Seth, thank you so much for your excellent presentation on property and cyber liability. You highlighted the ongoing challenges in property market, from CAT exposures and valuation scrutiny to infrastructure vulnerabilities. We really appreciate that. And gentlemen, your guidance on all of those underwriting expectations, resilience measures, and proactive governance give our members actionable steps to take back to their teams and their superiors. So together, today's presentation reinforced our key theme. While the risk environment remains complex and dynamic, it's a good time to be a risk manager. Preparation and strong data and strategic engagement with carriers truly make a difference. And together, as water and wastewater utilities, we play a critical role in our communities. And thoughtful risk management is central to sustaining that mission. Thank you again to our distinguished speakers for sharing your expertise. And a quick announcement, we are, as I indicated in my email to you, we are planning an in-person meeting next Wednesday at Parma during lunch hour at the lunch hall. So please take a look at the email and look out for an Outlook invitation to that as well. If you're there, please try to stop by and say hello. We've met all of you virtually, but not many of you in person, so it would be great to meet you in person. And the next webinar is going to be our open forum session in March. We will talk about this particular presentation and key takeaways, talk about upcoming presentations, and also please feel free to bring any questions or concerns about what you're seeing in your daily lives as a risk professional to the group. We're here to help each other and lift each other up. So please plan to join in March. And if you can, please join us next Wednesday for lunch. Thank you very much, everyone. I'm really glad you could make it. And thanks to our presenters once again. Have a great day.
Thanks, everyone.
Thanks,
Have a good
Vladimir.
day.
Bye-bye.